For the first time since late 2020, McDonald's is seeing a decline in global sales. The fast food giant reported a 1% drop, signaling a worrying trend. Its stock responded with a steep 15% fall, and customers are clearly feeling the pinch, opting more often to eat at home rather than pay rising menu prices. Unexpectedly, global sales slumped just as consumer confidence took a hit from ongoing tariff disruptions. McDonald's is caught between trying to lower prices and navigating the fallout from Trump-era trade policies. This quarter alone saw the closure of 12,000 locations, the loss of 60,000 jobs, and a revenue wipeout of $5 billion. This isn't a reporting glitch, it's a full-scale crisis. In Chicago, CEO Chris Kempczinski made a dramatic announcement. McDonald's would pause all U.S. operations to stem further financial damage. The effect was immediate. McDonald's stock plunged another 18%, and within hours, a $30 billion class action lawsuit backed by 1,700 franchisees hit a federal court. The legal challenge blames U.S. tariffs for crippling supply chains and breaking the low-cost model that built McDonald's into a global powerhouse. From the once mighty Big Mac to a symbol of a failing strategy, McDonald's sudden pullback raises a tough question. Is Make America Great Again still a rallying cry, or now a warning about the dangers of protectionism? On March 1, 2025, the America First 2.0 order introduced the most aggressive tariff package in modern U.S. history. Imports from Canada and Mexico were hit with a 25% tax, with some items facing possible hikes to 145%. China was soon targeted with even higher levies, described by Reuters as eye-watering. Retaliation came fast. Canada responded with 25% tariffs on $30 billion in U.S. exports, including beef and cheese. Europe banned red meat and dairy from the U.S., a devastating blow for McDonald's. The company's lean, import-heavy supply chain collapsed within 90 days. Nearly 70% of its beef came from Canada, along with cheese from Europe and frozen fries from overseas. Prices soared. U.S. ground beef costs have jumped 43% since 2020, and Lamb Weston, a major fry supplier, hiked prices 23% just to break even. But it wasn't just food. Paper wrappers and plastic cups made in Mexico and China now cost 25% more, pushing packaging costs up 50%. McDonald's $1 menu, built on volume and razor-thin profits, fell apart. According to the National Restaurant Association, most fast food chains operate on pre-tax margins under 5%. A 10% cost spike wipes that out instantly. And in spring 2025, wholesale food prices were already 35% higher than pre-pandemic levels. Inside McDonald's, U.S. same-store sales dropped 3.6%, the worst performance since the 2020 pandemic. No matter how many combo deals or marketing blitzes they tried, costs were rising twice as fast as sales, turning every promotion into a loss maker. And this could just be the beginning. If tariffs climb to the proposed 145%, OECD analysts predict U.S. growth could sink to 2.2%, with inflation spiking. For McDonald's, every beat from the fryer signals a deeper problem, a broken model bleeding money. The first major casualty? The once legendary $1 menu. Once essential to McDonald's appeal among low-income families, it became unsustainable as ingredient and packaging costs surged 35% since 2019. According to internal reports, costs across the board, from beef to cheese to wrappers, have risen steadily. With no cushion in its margins, McDonald's had to raise prices simply to stay afloat. The consequences were immediate. Thousands of loyal budget-conscious customers stopped coming. In early Q1 2025, revenue from value combo meals plummeted 18%. Franchise owners were bleeding cash. Promotions and discounts didn't stop the losses. They only deepened the hole. A cornerstone of the McDonald's brand, affordable meals for everyone, collapsed under economic pressure. A troubling new gap has emerged: the price of a Big Mac in the U.S. versus China. For 20 years, the difference rarely exceeded 50%. Now it's far worse. A Big Mac in the U.S. averages $5.29, while in China it sells for $3.53, a $1.76 difference, making it nearly 50% more expensive in America. For U.S. customers, this turned a familiar staple into a luxury item. Behind the scenes, Input costs were soaring faster than wages. Franchisees were under strain, and McDonald's leadership saw the writing on the wall. Under pressure, McDonald's approved Project Golden Arch Exit, a radical pivot. 6 United States plants were closed, and operations moved to Vietnam and Brazil to cut costs and dodge tariffs. In Brazil, meat giant JBS Group pledged $100 million to build new processing plants in Vietnam. These facilities will supply beef, pork, and chicken directly to McDonald's, particularly for North American operations. While this lowers expenses, it opens a Pandora's box of logistical and quality risks. For 50 years, McDonald's used a just-in-time model, promising fresh ingredients within 7 days. That system is now replaced by a complex network involving cold storage, shipping ports, and overseas transport. If anything goes wrong, a storm, a port delay, a cold storage failure, the ingredients can spoil. Already, batches have been rejected for failing freshness checks, putting the brand's reputation on the line. In today's environment, McDonald's could run out of beef or fries in a matter of days. The risk is no longer theoretical. Across Ohio, Iowa, and Texas, McDonald's employees are feeling the hit. Restaurants are shutting down, operating at half capacity, or running out of inventory. Iowa, once a hub for potato processing, is suffering. Factory workers are losing jobs or being shifted to lower-paying manual labor. The Department of Labor reported that 24,000 food processing jobs were lost or reduced in the first quarter of 2025, up 18% from last year. This is more than just a labor crisis. It's a collapse of the entire business model. With tariffs reaching up to 145% on food and 50% on packaging, McDonald's can no longer rely on low prices. Even a chain that used to thrive with 5% margins is now facing negative returns before a single burger is served. That's why the move overseas is being framed as the only escape route. But it's not without risk. If the quality drops, if burgers don't taste the same or fries don't stay crisp, customers may not come back. And McDonald's no longer holds the crown for cheap eats. That title is under threat. Rivals aren't standing still. Wendy's is promoting value meals priced 10% below McDonald's. Burger King's $2.99 Whoppers are attracting budget diners. KFC has introduced a streamlined menu aimed at families trying to save. While competitors tighten their strategies, McDonald's is busy building a new global supply chain from scratch, a slow, risky process. The race is on, and the future of the Golden Arches hangs in the balance. McDonald's is now trying to balance rising costs, maintain food quality, outpace rivals, and hold on to public trust, all while hoping customers still see value in the brand. If these efforts fail, the Golden Arches may dim for good. No matter how strategic McDonald's appears in dodging tariffs, the reality is unavoidable. Higher costs are now baked into every burger, drink, and box of fries. As the crisis deepens, fast food workers are taking the biggest hit. The Institute for Supply Management reported 3 consecutive months of manufacturing job losses, with 116,000 layoffs in the first quarter of 2025. That wave quickly crashed into the restaurant industry. The U.S. Department of Labor reported a 245% increase in restaurant layoff notices in February, with 1.79 million filings, which, honestly, are the worst numbers since the 2020 collapse. McDonald's confirmed it would cut 60,000 jobs across its production, logistics, and assembly networks, targeting 3 key states: Ohio, Iowa, and Texas. These regions are pillars of the McDonald's U.S. supply system and home to communities where the company is, a major employer. Once factory lines stopped, local tax revenues fell by 40% in a single month. The job cuts triggered widespread outrage. The Teamsters Union called for a national strike, representing hundreds of thousands of workers in warehousing and delivery. On May 5th, Teamsters President Sean O'Brien warned if federal unemployment funds weren't replenished, delivery walkouts would surge. That warning followed UPS's announcement of 20,000 layoffs and 73 closures, all traced back to tariff-driven drops in Amazon shipments. The dominoes continued falling. Bun suppliers like Flowers Foods are under pressure, cold storage hubs in Iowa are buckling, and small vendors are collapsing, including a Dallas packaging firm that went bankrupt when tariffs doubled. Midwest farmers now have stockpiles of unsold cheese and potatoes. The hardest hit? Everyday Americans. With 60,000 jobs gone, household incomes have cratered, and cheap food options are disappearing. In rural towns, especially in Ohio, panic is setting in. One Springfield resident put it plainly, "We're losing tax money, losing jobs, and we don't even know what's for dinner." With the dollar menu gone, these layoffs could be just the opening act of a bigger breakdown that threatens to stretch from the East Coast to the Midwest, unless DC reverses course on its aggressive tariff strategy. When McDonald's began pulling back from the U.S. market under Project Golden Arch exit, the legal and financial fallout came fast. On May 28, 2025, the National Owners Association, representing over 1,200 franchisees, filed a class action lawsuit in federal court in Illinois. Their claim average input costs are up 40% since the new tariffs, while McDonald's froze prices to keep customers, losing up to 90 cents per burger. And it wasn't just franchisees raising red flags. In its year-end legal review, Gibson Dunn reported that investors like BlackRock and Vanguard slammed McDonald's for not warning them about policy risks before the tariff wave hit. As a result, McDonald's market value plummeted 18% in just the first 2 months of Q2 2025. Now those investment giants are demanding compensation and transparency moving forward. Meanwhile, the Department of Justice is investigating whether McDonald's violated the WARN Act, which requires 60 days' notice before mass layoffs. Reports from the Wall Street Journal suggest McDonald's shut U.S. offices in early May to prepare layoff notices behind closed doors, potentially violating federal law. If proven, this could lead to penalties and additional unemployment costs for tens of thousands of affected workers. With lawsuits from franchisees, scrutiny from top investors, and DOJ investigations underway, this is no longer just a business setback. It's a test of the entire McDonald's franchise model and a potential warning sign for the broader fast food sector. Between May 19th and 23rd, McDonald's stock, MCD, dropped 22%, erasing nearly $900 million in value over just 5 trading days. The shockwaves dragged the entire S&P 500 food and beverage sector to its lowest level in 5 years. Investors are pulling back as tariffs bite deep into profits, and McDonald's isn't alone. According to Reuters, other fast food giants are eyeing the exits from the Make in America playbook. Indonesia recently slashed import duties to attract global supply chains, and now insiders say Starbucks and Burger King may shift packaging operations to Indonesia, where tariffs range from 0 to 5%, compared to the U.S. rate of 25 to 50%. If this shift becomes a trend, Make America could become a punchline, with supply deals quietly moving overseas. The World Trade Organization has issued a stark warning. Investor confidence in the U.S. economic climate is in serious decline. If McDonald's, the very symbol of American fast food, is pulling back from U.S. production, it could trigger a chain reaction that threatens packaging, printing, and food prep industries nationwide. The same tariff policy that promised a revival of domestic manufacturing is now raising serious doubts about whether Make in America is even sustainable. The America First tariff initiative started with good intentions: protect local jobs, support U.S. industries. But now, McDonald's, born in Illinois, is reeling from the fallout. Faced with profit losses, layoffs, and broken supply lines, the brand that served millions of working families for decades is struggling to survive. The cheap burger has become an expensive liability. And when McDonald's closed dozens of its U.S. hubs, it didn't just cut jobs, it gutted entire communities. This crisis isn't just about one company. If a global titan with more than 80 years of American roots can't stay afloat, what hope is there for smaller firms? How many factories and suppliers will now shift operations to low-tax markets, leaving American workers and investors behind? The House Agriculture Committee will begin hearings in June 2025 to uncover why affordable meals are vanishing and how to stabilize a crumbling supply chain. This could be the final opportunity for CEOs, unions, farmers, and lawmakers to advocate for smarter tariffs, ones that protect manufacturing without hurting consumers. What's your view on this unfolding crisis? Let us know in the comments, and share this video to spread the word before it's too late.